Last week, Delta Airlines reported its 2025 earnings. Buried in the numbers was a fact that really caught my eye. For the first time, Delta is making more money from its first class and Comfort Plus passengers than its main cabin. In the fourth quarter, main cabin revenue decreased by 7%, while premium cabin revenue increased by 9%. This marked the first quarter in Delta's history where premium revenue exceeded economy revenue. Now, let's think about what that means. An airline, a business built on moving masses of people, now makes more from the small fraction up front than from everyone else combined. The people in the back of the plane, the majority of travelers, are becoming economically secondary to the airline's success. But here's what really got me. When CEO Ed Bastian discussed these results, he didn't treat it as an anomaly. Bastian said Delta sits at the top of the quote K in the so called K shaped economy, with more revenue coming from higher spending customers. And then he said something about where the airline is headed. Quote, effectively, none of our growth in seats will be in the main cabin. Virtually all will be in the premium sector. The CEO of a major American airline is telling investors, essentially, we're done betting on ordinary consumers. The future is premium. That's not a business decision made in isolation. This surge in premium demand is directly aligned with the dramatic concentration of wealth in the US, where the top 10% of households account for nearly 50% of all consumer spending in the second quarter of 2025. That's according to Moody's Analytics. One airplane, two economies. The people out front spending freely, the people in back cutting back. And the CEO explicitly naming it, we're at the top of the K. That image, the K shaped economy captured in the cross section of a Boeing 737, is what this episode is about. Not inequality as an abstraction, but as something you can see in assignments and price tiers and where companies choose to invest. The economy splitting into divergent trajectories and the aggregate statistics that hide it from view. I've been looking into this for months, and I kept resisting where the data was pointing. I understood inequality, at least intellectually, but I was still operating as if the basic machinery of shared prosperity worked the way I'd been taught. Growth might be unevenly distributed, sure, but it was still distributed. Delta's earnings report made me realize I was wrong about something fundamental. When we say the economy is growing, we might be describing something that has almost nothing to do with most people's lives. Welcome back to Interconnected. I'm your host, and today we're pulling apart something that's been nagging at me since I saw that spending concentration figure. Okay, so here's what's bothering me. I'd heard economists describe something called a K shaped economy. The idea that after the pandemic, recovery split into two directions, like the arms of the letter K. Some people going up, others going down. I'd nodded along when I heard it, filed it under inequality is bad, and moved on. But that 50% number wasn't describing a temporary divergence. It wasn't pandemic aftermath. This was 2025 data showing something structural. And the more I looked, the more I found versions of the same pattern everywhere in stock ownership, in wage growth, in consumer health indices, in corporate earnings. What unsettled me wasn't only the inequality, it was realizing that the standard economic indicators, the ones I checked, the ones that make headlines, the ones politicians cite to tell us things are going well, might be measuring something real while missing something essential. The economy can be, quote, growing in ways that have almost nothing to do with most people's lived experience. Most of us carry an assumption that works something like this. When the economy grows, that growth eventually reaches everyone. The mechanisms differ: wages, job opportunities, lower prices from efficiency gains. But the fundamental belief is that GDP growth is a shared phenomenon. When consumer spending rises, that means Americans are doing better. When the stock market hits new highs, that benefits retirement savers across income levels. These feel like reasonable beliefs. They match the rhetoric we've absorbed from decades of political messaging. A rising tide lifts all boats. I understood it was imperfect, that inequality meant some boats rose faster than others, but I assumed the basic machinery was still working, just unevenly. Strong consumer spending meant consumers were doing well, full stop. The question that hooked me: what if that's not what the numbers mean at all? So I started with what we actually know about consumer spending, because that's where the 50% figure came from. And here's the thing: the common understanding isn't baseless. Consumer spending really has been growing. In late 2024 and into 2025, spending growth continued even as inflation remained elevated. Economists pointed to this as evidence of consumer resilience. The American consumer, we were told, keeps powering the economy forward. This became the story. Despite challenges, households are hanging in there. And there's real evidence for this. Credit card spending held up. Retail sales exceeded expectations in multiple quarters. The labor market stayed tighter than many predicted. If you're reading the headlines, the picture looks like broad-based stability. So why would smart, informed people believe the economy is working for most Americans? Because the aggregate data supports that interpretation. If total consumer spending is strong, it seems logical that consumers, plural, widespread, are spending. If unemployment is low, it seems reasonable that workers have leverage. If GDP is growing, it feels like growth is happening. I wanted to understand why the aggregate story seems so convincing before I looked at what complicated it. Then I started seeing the decomposition. The Bank of America Institute published data breaking down spending by income: top third, middle third, bottom third. And the patterns weren't remotely similar. Spending from consumers in the top third of income distribution rose 4% year over year. The lower groups lagged significantly behind. One analyst at Bank of America noted, almost in passing, that from a macroeconomic perspective, higher and middle income household consumers' spending accounts for the bulk of overall U.S. consumption. So the economy can continue to grow as a K for some time, meaning the aggregate numbers look fine, robust even, while describing something that isn't broadly shared at all. The spending growth that makes headlines isn't distributed, it's concentrated. And the people driving those numbers are not representative of most Americans' experience. But I couldn't figure out what was actually happening at the bottom. The aggregate data was drowning out the distribution story, and I didn't have a way in. So I talked to someone who'd been tracking consumer financial health at a granular level. Let's call her Helen, a composite character drawn from researchers working on consumer welfare data. I told her what I was seeing in the spending concentration numbers and asked what it looked like from the ground. She said something that reframed the whole thing for me. She said, "You're looking at spending data like it measures consumer health. But spending can stay elevated for a while, even when people are struggling. They don't stop eating. They don't stop driving to work. They start making trade-offs that don't show up in the top line numbers until they suddenly do." I asked her, what kind of trade-offs? Exhausted savings, carrying balances instead of paying off credit cards, buying smaller quantities more frequently because you can't afford a Costco run, skipping preventive care. The spending might look stable, but the cushion underneath it is disappearing. She pointed me towards something called the Consumer Health Index, which tracks purchasing power and financial stability across income groups. And the picture it showed was nothing like the aggregate story. At the start of 2025, scores rose across all income groups. But by mid-year, scores for middle and low-income adults started falling. And for those earning less than 50,000 annually, the index recently dropped into negative territory, signaling an outright contraction in demand. Negative territory for a third of the population, while headlines described strong consumer spending. That's when I realized I'd been asking the wrong question. I'd been asking whether the economy was growing, but growth is an average, and averages can hide almost anything. The better question was, whose economy is growing? That conversation with Helen shifted where I was looking. I started digging into the composition of growth, not only whether numbers were positive, but who was making them positive. And the pattern I found in spending showed up everywhere I looked. Stock ownership is the clearest example. About 62% of American adults own stocks in some form, directly, through retirement accounts, through mutual funds. Now, that sounds like broad participation. It sounds like when the market rises, most Americans benefit. And that's the statistic that often gets cited. But here's what that number hides. The top 10% of households own 93% of all stocks and mutual fund shares. The bottom 50% of Americans, they own 1.1%. So yes, technically, most adults own stocks. But the gains from the rising markets flow almost entirely to people who already have wealth. When politicians point to stock market performance as evidence of economic health, they're describing something that isn't relevant to nearly half of Americans at all. And the concentration has been accelerating. The top 1% saw their share of public equity markets rise from 40% in 2002 to 54% in 2023. The rising tide isn't lifting boats proportionally. It's lifting the yachts and leaving the dinghies treading water. I kept finding things that didn't fit the standard story. Wage growth, for instance. We hear about wage growth as evidence of worker prosperity. But when I looked at the data by income level, I found something strange. After-tax wages for the lowest income tercile grew just 1.3% year over year. For higher income workers, wage growth accelerated to 3.2%, its third consecutive monthly increase. The gap between top and bottom earners' wage growth is now the widest it's been since February of 2021. This was during a period when aggregate wage growth looked healthy. The average was fine. The distribution was diverging. I called someone who works inside the labor market data, a composite I'll call David, drawn from economists who study wage dynamics. I was trying to make sense of what I was seeing, so I told him, I keep finding things that contradict what I thought I knew. The aggregate numbers look stable, but when I decompose them, the picture falls apart. Am I missing something? He said, the aggregate is real, but it's incomplete in ways that matter a lot. Here's how I'd put it. You can have an economy where the average is pulled up by a relatively small number of people doing extremely well, while the majority is flat or slipping. The average still rises. The median stagnates. And because we report averages, the median becomes invisible. I asked him when this started, whether it was pandemic related or something temporary. He said, this goes back decades. Between 1980 and 2022, the bottom 90% of earners had wage growth of 36% total, over 40 years. The richest 1% had growth of 162%. The top 0.1%, 300%. The pandemic didn't create this, it just made it harder to ignore. That historical comparison stopped me. 36% over 4 decades. That's less than 1% per year, not adjusted for the rising costs of housing, healthcare, and education that have outpaced general inflation. Then he said something else that I've been sitting with since. David said, there was a narrowing of wealth inequality coming out of the pandemic. People at the bottom saw bigger wage gains for a couple of years, tight labor market, some bargaining power. That's gone into reverse now. The gap is widening again. It's early days, but the trend line is clear. So, I was holding two pictures now. The official picture, the one in the headlines, the one politicians use, the one I'd been operating on, showed an economy that was resilient, still growing, defying pessimistic predictions. The other picture showed that growth increasingly concentrated, that the mechanics of shared prosperity were broken, that the American economy could technically expand while leaving most people behind. And I couldn't figure out which one was more true, or whether true was even the right frame. Then something started to shift. The pieces weren't just divergent, they were connected. There was a mechanism. I'd been treating inequality as a static condition. Some people have more, others have less. The distribution is unequal. That's all true, but it's descriptive, not explanatory. It doesn't tell you why the gap persists or why it keeps growing. I'd assumed inequality was a problem of distribution, that the pie was being sliced unevenly. What I started seeing was something different, a feedback loop where having wealth mechanically generates more wealth, and that process reinforces itself. The economist Thomas Hungerford studied this directly. He found that capital gains and dividends, income from owning things rather than working, have become the greatest contributing factor to inequality. And the mechanism is almost mechanical. If you own assets that appreciate, you don't have to invest more to get wealthier. The shares you already own increase in value. Your wealth grows whether you add to it or not. Academic researchers have formalized this as a feedback loop. A positive shock in financial markets disproportionately benefits wealthier investors because they own more of the market. That increases wealth concentration. Concentrated wealth drives up demand for assets, pushing prices higher. Higher asset prices benefit the wealthy again. The cycle reinforces itself. It's how the mechanics work when you have an economy where wealth generates returns and those returns compound. The people who already have wealth accumulate more of it automatically. The people who don't have wealth can't access that compounding. They're not excluded from the economy, they're just excluded from the part of it that multiplies. I was describing what I was seeing to another source, a composite I'll call Marcus, someone who studies how economic policy interacts with these wealth dynamics. As I talked, I could hear myself understanding it better. I said something like, it seems like the economy has two different operating systems running at once. One where you work for income and try to build stability, and another where assets generate returns that compound without effort. And the second system is eating the first. He interrupted me and said, that's closer than most people get. But here's what you're still missing. The two systems aren't just different, they're connected in ways that make the gap self-sustaining. The returns from the wealth system get used to shape the rules of the work system. Well, I asked him what he meant by that. Wealthy individuals and corporations fund political campaigns. They shape policy. They get tax codes that treat their income favorably. Long-term capital gains taxed at 20%, while wages are taxed at up to 37%. They get policies that inflate asset prices. Every advantage they secure widens the gap further. It's not a bug. It's the system doing what the rules incentivized it to do. That reframe hit hard. I've been thinking about the K-shape as an outcome, something that happened as a result of economic trends. But what Marcus was describing was the K-shape as a function, something the system produces because of how it's structured. And it wasn't just wealth or income. He pointed me toward the tariff data. The Yale Budget Lab has been tracking how tariffs affect different income groups, And the numbers are stark. Tariffs are regressive. They burden households at the bottom of the income ladder more than those at the top, as a share of income. The short run burden on the lowest income decile is more than 3 times that of the top decile. A policy that's sold as protecting American workers actually lands hardest on the people with the least margin. Lower income families spend a greater share of their income on consumption, and a greater share of that consumption on imported goods, which tends to be cheaper than domestic alternatives. The tariffs are, as one analyst put it, almost tailor made to hit lower income families. That pattern was everywhere. At every point where policy could either narrow the gap or widen it, the structure was pushing toward widening. Not because anyone planned it that way in some smoke filled room, because the people with the most resources had the most influence over the rules, and they use that influence in ways that tend to benefit people like them. Once I started seeing this way, I couldn't stop seeing it. The corporate earning calls were the strangest part. Company after company was describing their customers not as a single market, but as two populations living in different economies. Procter & Gamble reported, quote, shopping behaviors. Wealthier customers buying bigger pack sizes from Costco, lower income customers exhausting their pantry before returning to stores, not buying in bulk because they couldn't afford the upfront cost, depleting what they had completely before replenishing. Coca-Cola was seeing the same thing. Their premium products, Topo Chico sparkling water, Fairlife protein shakes, were driving sales growth. Those skewed toward higher income consumers. At the same time, they were seeing increased demand at dollar stores where lower income consumers hunt for deals. The same company growing at both ends with a hollowed out middle. The hotel chain Hilton reported that revenue dropped for their affordable brands, Hampton Inn, Homewood Suites, while luxury offerings performed exceptionally well. The CEO said he expected the bifurcation to resolve, predicted the middle and low end would, quote, move up in 2026. But there was no structural evidence for that optimism, only hope. And then there's the auto market. Last month, the average price for a new vehicle surpassed $50,000 for the first time ever. Meanwhile, auto loan defaults and repossessions are rising, particularly for borrowers with credit scores below 620. People are paying more for cars than ever before, and more people than ever can't keep up with the payments. Consumer bankruptcies hit their highest level in 5 years. The share of new delinquencies across all loan products reached an 11-year high. Student loan delinquencies continue to break records. The implications of all this were starting to hit me. I needed to talk it through with someone who understood the human reality of it, someone who'd seen what it means to live inside this pattern. I talked to someone I'll call Rosa, a composite drawn from financial counselors and community advocates who work with families navigating economic instability. I said, if I understand this right, then a lot of what I believed about how to get ahead, how to be secure, how things are supposed to work, it's not wrong exactly, but it's incomplete in ways that really matter. People can do everything right and still end up stuck. She sat quiet for a second, and then she said, they don't just end up stuck, they end up confused about why they're stuck. Because the story they've been told doesn't match what's happening to them. They think they're failing. They're not. They're succeeding at a game that was restructured while they were playing it. The ways that used to lead to stability, education, steady employment, home ownership, those still exist. But the costs have risen faster than wages for decades. And the returns on owning things have outpaced the returns on working. So even if you do everything the playbook says, you're running a race where the finish line keeps moving. You're not falling behind because you're lazy or stupid. You're falling behind because the escalator you're on is going down while the one next to you goes up. That image, two escalators, One ascending, one descending, both called the economy, is what finally crystallized it for me. We describe the economy as if it's one thing: GDP growth, unemployment rate, consumer spending, single numbers that apply to everyone. But that's the statistical fiction. There's an economy for people with assets and an economy for people without them. They're connected. The spending at the top props up jobs at the bottom. The debt at the bottom generates returns at the top. But they're not the same economy. And the gap between them is structural, self reinforcing, and getting wider. Here's what shifted for me when I finally saw it that way. I've been asking the wrong questions. Whenever I heard economic news, GDP growth, stock market performance, consumer spending figures, I was asking, is the economy doing well? As if the economy were a unified thing that could be described with a single adjective. The better question is, whose economy are we measuring? Strong consumer spending can coexist with consumer distress. Stock market highs can coexist with retirement insecurity. GDP growth can coexist with declining real purchasing power for a majority of workers. The numbers aren't lies, they're just incomplete. And their incompleteness systematically favors certain narratives. Once you see this, you start asking different questions of policymakers and institutions. Not is unemployment low, but what kinds of jobs are being created? At what wages? With what stability? Not is the stock market up, but who owns the market? And what does appreciation mean for people who don't? Not are consumers spending, but are they spending from security or from desperation? From savings or from debt? These questions don't have simple answers, but they're the questions that actually describe whether an economy is working for the people inside it. I asked Rosa something near the end of our conversation. If we understand it this way, what should we actually be asking? She said, I think you have to ask whether the things you're pursuing are actually available in the economy. Not the economy you were promised, not the economy in the headlines, the one you actually live in. She continued, for a lot of the people I work with, that means accepting something painful. The rules they were taught are outdated. Saving 10% of your paycheck is still good advice, but it won't build wealth if your wages can't outpace your cost of living. Buying a house is still the biggest asset most families will ever have, but not if the mortgage is so stretched that one medical bill puts you underwater. And here's what I'm sitting with. If the wealth feedback loop is real, if wealth generates more wealth automatically while wages stagnate, then the question isn't how to succeed. It's whether the kind of success you were taught to pursue still exists in the same form, whether the map you're using has any relationship to the territory. This doesn't mean individual effort is meaningless, but it means individual effort is operating in a context that matters a lot. And that context isn't neutral. It's a system with its own logic, and the logic currently favors compounding over earning. For listeners facing decisions right now about jobs, about housing, about education, about retirement, I don't have the answers. What I have is a different frame. When you're evaluating a choice, ask not what the expected outcome is, but whose economy that expectation is calibrated to. Ask who benefits from the assumptions you're making. Ask whether the advice you have absorbed come from people whose circumstances resemble yours. And maybe most importantly, ask why the story you've been told about how things work doesn't match your lived experience. That mismatch isn't a personal failure. It's information about the system. So, the question I'm sitting with now isn't the one I expected. I started this investigation frustrated by a spending concentration number that confused me. I followed that confusion through stock ownership data, wage growth patterns, consumer health indices, corporate earning calls, and policy analysis. I talked to researchers and economists and people who work with struggling families, and I kept finding the same shape everywhere. an economy that looks unified from above, but splits into divergent trajectories when you look at it from inside. The intellectual part of this is clear to me now. I understand the wealth feedback loop, the concentration of returns, the way aggregate statistics can describe something real while missing something very essential. I understand how policy can widen gaps even when framed as benefiting workers. I understand that the economy we talk about and the economy we live in are increasingly different things. But the emotional part is harder, because if this is real, then the story I've been telling myself, that participating in the economy, working hard, making reasonable choices, would eventually translate into stability and security. That story is incomplete in ways that truly matter. And I suspect a lot of listeners are in the same position. You've been operating on assumptions that made sense, that were reasonable, that matched everything you were taught. And then the terrain shifted underneath you. The 50% figure that started all this, that the top 10% accounts for half of consumer spending, doesn't merely describe inequality. It describes an economy that can grow without you, that can be, quote, strong in ways that have nothing to do with your life, that can look healthy in the aggregate while you struggle to keep up. Rosa said something that keeps coming back to me. She said, people think they're failing. They're not. They're succeeding at a game that was restructured while they were trying their best. What changes once we see this? I'm not sure yet, but at minimum, it changes what questions we ask. It changes how we interpret the news. It changes what we expect from institutions and what we demand from policymakers. And maybe it changes how we evaluate our own choices, with less self blame and more awareness of context. Until next time on Interconnected, keep seeking those patterns.